Well, hello and welcome back to Master Horne Investing. This is Brian Horne. I hope you're having a great day today. So I have a little bit of update on the markets, especially since that lower than expected CPI reading yesterday, which set the markets rocking higher. So just remember, I don't give you any personal investment advice, and this presentation is just to kind of help you make some decisions, but doesn't constitute any personal investment advice. So let's look at where we're at right now and where the markets are headed. Well, ever since that CPI number came out, everything kind of changed. So we'll go over the markets here and look at, but everything's showing near term, that means like over the next 6 weeks bullish. Some things longer term bullish, like the gold. Stocks look like they'll be good for the next several weeks, maybe up into Christmas time. And then we're expecting a downturn next year again, which will take us to lower lows. But let's look and see where we are right now. So this is where the markets were. So let's look at the NASDAQ. So here we got the NASDAQ coming down. And you can see from these charts over here that we've been on this down slide. We've been kind of shaking it down like this. Well, we had this double bottom right down here, and everything kind of shot higher. We had this big jump. And it looks like we're kind of having a repeat of this kind of a scenario. So we're kind of expecting this to come up and probably even cross the 200-day moving average. I wouldn't be surprised if it did, but at least touch it, which means we still have another at least 10% to go on this NASDAQ market. The NASDAQ looks the most oversold. Looks like it's the one that probably wants to run the most. This is probably the best market to be in if you want to be in. Not necessarily a buy recommendation. Longer term, we're still headed lower. So this is just a short-term activity. So again, if you're out here with your 401k, if you're kind of invested in your 401k and you've never come out of the market and you've just been riding this thing up and down, well, you don't want to get out now necessarily, or you could get back in if you did get out and catch a little run up here and maybe make 5 or 10% on your portfolio. But it is still a risky time. Things can still happen, but for now, things look good on the charts. Let's look at the S&P for the last 12 months. Okay, so here we got the same kind of thing. We got this downtrend coming down. We had this double bottom again right here. Things came up, hit the line. That's where we kind of put in some sell recommendations. Bought SQQQ, SPXU, so forth. It came down. I actually sold some in here, so I made a little bit of money. And then, boom, we had this pop again. And again, not only does this look like it's going to go up to the 200-day moving average, I'll bet it comes up at least to that high and we get kind of a double top. So again, that's got another 7 to 10% move potentially over the next, 4 to 6 weeks. So again, if you don't want to be trying to time these things because we got wild markets, just stay out. Just keep your money in the money market fund. Don't worry about the stocks and so much. Just keep your money safe because there's a lot of volatility. And even if everything looks good, it doesn't mean something can't blindside us and boom, things open up down. I mean, you remember back in the terrorist things with 9/11. I mean, things were starting to recover, and all of a sudden, the markets were closed for like a week or 2 weeks, and then when they finally opened, everything opened up like 10 or 15% lower. I mean, stuff can happen. So this is not a sure thing, but it looks good right now. How about the small cap stocks? Well, small cap stocks kind of bottom. They've been having this kind of uptrend like here. You see this kind of trend going. Again, they've already broken above their 200-day moving average, and they again are probably going to come up to here, or you could even see maybe another run up into this range. So small cap stocks, NASDAQ stocks, they're all looking pretty good right now. Now let's look at gold. I mean, this is kind of like an everything rally. Bonds are rallying, stocks are rallying, gold's rallying. I mean, it's just like an everything rallying because of this CPI number. Well, gold seemed to have made a double bottom, almost a triple bottom right here, and then boom, crossed its 100-day moving average. Now it's heading up to its 200-day moving average. This looks like a good long-term trend for gold. So I still think gold's a good place to be. Silver, same thing. Look, we had this kind of trend lines going up this way, and it looks like it's a good turning point for gold and silver. It looks like they'll be doing well, especially over the next month or two also. But I still like these ones. These are probably the most undervalued areas in the market right now. A lot of things have participated going up. Silver and gold never did. They typically do very well when there's inflation and stagflation. And now that interest rates have kind of like gone up and sort of peaked a little bit, boy, gold and silver could have some good runs in here. So let's look at bonds. So this is the 10-year bond. You can see how the interest rate was going up on the 10-year bond. And then we had this sort of almost like a double top up here, and wham, this huge drop. in bond rates, where we'd hit up here like 4.5%, and all of a sudden down to 3.8. So that's maybe a little bit oversold. We've clearly broken this trend line. So bonds could still do pretty well. And then next year, if the markets do really bad, we kind of get more of a recession, interest rates tend to go lower when you're in a recession. So we may have seen the high on bonds. So having bonds in your portfolio could be pretty good, because not only do they pay interest, but if interest rates come down, they go up in value. So bonds go opposite of interest rates. So this is the 10-year yield on the bond. We're looking at the yield here, but bonds would be going opposite. So if you were looking at a bond fund, it would be going like this, and then it would turn and it kind of popped. So we're kind of, the funds would be looking at, again, a good, whoop, missed that circle. That'd be a good time to buy. So I sold my SQQQ and SPXU, I think it was last Tuesday or something, maybe Wednesday, before the CPI number came out, because I was kind of a little nervous about it. And then I didn't sell my CAT and my Rivian puts, sorry. And so I sold those this morning. I should have sold them yesterday as soon as the markets opened up. But anyway, so I still think there's going to be good buys in the future if I have these puts on CAT and Rivian. But we may have to wait for this market run to be over and then buy them again, because they're looks like they're pretty well oversold, especially if we go into a recession. So how much a move to expect? Well, we're still looking for a 5 to 15% return over the next 2 to 6 weeks, depending on which market. S&P 500, Dow. The Dow's already done a lot of running. I don't know if it's going to run a lot more, but the NASDAQ could certainly go up 10 or 15%, which means that TQQQ, which goes up triple. So it goes up 3 times whatever the market does. So if this were to go up 10%, you can make 30% on your TQQQ. But again, you don't want to like throw all your money in and put all your eggs in one basket, because things can happen and things can turn on a dime, especially in these volatile markets. So this isn't a guaranteed win. Anything can go wrong. Things can happen in the market. You have wars that can happen. You got stuff going on with Russia, Israel, Iran, North Korea's trying to flex its muscles, China and Taiwan. So we've got lots of stuff going on. Natural disasters can happen anytime, volcanoes, earthquakes. I mean, just stuff that can cause havoc. We still have problems going on with the Mississippi River and the Euphrates rivers being extremely low levels and not being able to move barges and stuff up and down them and so forth. Remember that, like I've already mentioned, those terrorist attacks like we saw in 9/11. Things can kind of happen sort of out of the blue, and all of a sudden stuff you thought was going okay turns negative. So it looks good right now for the next short term. We normally have a Christmas rally this time of year, so we got a kind of an annual effect that's going on. We have these lower interest rates that have popped in since the lower than expected CPI number, inflation number. There's no Fed meeting until another like 6 weeks from now. So there's not really anything to kind of like derail the markets on a normal basis. I mean, there's not some kind of thing. Plus, there's a lot of puts in the market, and when there's lots of puts in the market likes to squeeze those out, and then those people have to buy back, and that creates more buying, and you kind of get this run up. So kind of still expecting we'll have a market run right now for a little while. So it's a good time to buy gold and silver coins. I like to buy coins and hold on to them. Not only, so this is still, we're looking at pretty good low prices and have them shipped to your house, and you can just own them at your house. You don't have to worry about day-to-day market things. If anything were ever to fall apart, you have those to fall back on. They tend to outpace inflation over time. Generally, they make more money than just sitting in the bank. Even if the bank's making 3 or 4%, which generally is not right now, but if you have an account that's paying that much, gold and silver tend to average better than that. So I still like gold and silver coins. I buy mine from Provident Metals. No, they don't pay me any money, but providentmetals.com, they generally don't have any commissions. They have free shipping. They mail them registered and insured to your house through the post office, and you can get delivered right to your house. So I kind of use Provident Metals to buy the gold and silver coins. Make sure you buy stuff that's usable. Like if you ever had to use your coins, like say there's an economic collapse or something, or you just need to sell them because I don't know, you lost your job. It's a lot easier to use coins because people trust the coins. A bar, people are known to take lead and then dip it in silver or gold and make it look like a gold bar, kind of filled like a gold or a silver bar. And so there's more people a little bit leery of bars. So if you have coins that are a little more tradable, usable, and so I like actually buying the silver coins. gold and silver coins. How about stocks? Well, gold and silver stocks can do very well. Like they can way outpace a lot of stuff when gold and silver go up because they go up like multiples. So if silver goes from like 21 to 30, that's almost a 50% move. So that's 40 to 45% move. Well, the silver stocks may go up 300%. So they have this kind of a leverage effect. So if you like gold and silver investing, in addition to buying the coins, you could also invest a little bit in gold and silver stocks. Gold stocks, Sand, Royal Gold down here, and AIG, and then MAG Silver, Fortuna Silver Mines, SVM, SILV. Those are good silver stocks that I like. So again, you don't ever want to put too much in any one thing. You don't want maybe more than 10% of your portfolio at any time in gold or silver stocks. So if you had 10,000 to invest, that means you only want 1,000 in gold and silver stocks. And here's like what, 6, 7 stocks or something. You can buy 1, 2, 3, 4, 5, 6. So that'd be like $150 each. Okay, just gives you an idea. Just a reminder to be prudent on your investment sizing. Don't put too much in any one area. Don't put all your eggs in one basket. If you don't feel like you want to get in and then have to watch this and then get out, and maybe things turn on you and then you get in and maybe your money goes up and then it goes down. And by the time you look at it again, you've lost money again. Then just stay out of the market for now because short term we might have a rally here. Longer term we're still headed lower. If you don't have to worry about stuff like that, just stay out of the market. Just stay in the money market fund or something, or buy bonds because bonds are starting to look okay. So on your 401k, you can still allocate some to the bond fund, some to the growth funds and things. But again, longer term, you don't want to be there. So this would be a short term kind of a trade where you maybe only stay in 3 weeks, 6 weeks, and then you'd get back out. Although if interest rates continue to go lower, again, the bond funds and your 401k would be the safer investment. Okay, this gives you some good investment ideas for the day, and you have a wonderful weekend.